You want to make sure that the IV is low as possible, because what happens is once you start getting into these calls, the puts, if the IV is very high, it's going to take a bigger move in order for you to get the same percentage that you would on a normal day where the IV isn't as high. So for example, if the IV was 130 or 140%, that's pretty fucking high. I would probably stay away from those contracts. 60%, 50%, 40%, even 30%. Those are pretty safe contracts to go to trade, and you'll start seeing. So if you trade high IV contracts, you could have a $2, $3, $4 move and you'll only net 15, 20%. Whereas if the IV was a lot lower, if it was 20, 30, 40%, if you have a $2, $3, $4 move on those, 70, 80, 90%. And these are all subjectives to the tickers. The day that you decide to trade on is all subjective, but you want to make sure that your IV is as low as you can possibly get it. Now, this is also not a metric that I rely on too heavily when I'm trading, especially like with the Greeks. Not one time have I ever was about to enter a position and stopped to look at the Greeks. The Greeks do play a part, especially theta, and theta is the most important Greek in my own personal opinion. Basically what theta is decay, but I've never stopped and said, hey, let me look at this gamma or let me look at this delta before I jump into these contracts so I can see. No, for one, time is of the essence when you're trading options. So if you're gonna get into play, then you need to get into play, and you don't need to be worried about the Greeks. That's the last thing you need to be worried about. If the contracts are not moving as good as you want them to move, or if they're moving kind of slow, then you may want to just consider cutting your position and start looking to re-enter if you have a high probability setup that presents itself.